Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, April 21st, 2010. Let's begin with the euro-dollar pair, which in today's trading continued its decline that it started from last Thursday when we had come close to the 1.37 area. In today's trading, we fell to 1.3357 as our intraday low. Talks between Greece, the European Union, and the International Monetary Fund got underway in Athens after a delay of 2 days, and investors are focusing on the many uncertainties and are shutting Greek bonds as well as the common European currency. Greek German 10-year yield spreads surged above 5 percentage points in low-volume trade on Wednesday, reaching 5.17 percentage points shortly before the New York Open. This yield spread means that Greece pays a yield of 8.24% to investors on a 10-year bond. Greece faces the prospect of having to repay 8.5 billion in euros in bonds that mature on May 19th, and the government is weighing how to present a decision to the public that the country will seek financial aid from the EU and the IMF. There are several questions that the market will be looking for in order to clarify the Greek situation. First, whether Greece has made an official request for aid. Second, what the exact role of the IMF will be. And third, whether the commitment of EU governments is still in doubt. In addition to the pressure on Greek bonds, we also had European equities down in today's trading, which pressured the euro. Drawing a Fibonacci retracement of the rally from 1.3280 to here around 1.3690, we see that today's support comes at the 78.6% retracement level after we had broken below the 61.8% level. We also retested that as resistance in today's trading. So we continue to move further down along this retracement path of this rally. So we'll see if we test this support around 1.3280 prior to some kind of resolution with the Greece debt situation. The pound-dollar pair, meanwhile, rallied from its support around 1.5350 in today's trading and was given a boost to hit a high of 1.5438 following a better-than-expected claimant count report. This pushed the price action above our medium and long-term moving averages, and we have used the 200-period moving averages in this hourly chart as our support for today. We also set up a short-term upward-sloping support trend line that has also acted as support. Today's move also reinforces that the market is ready to keep the pound-dollar pair above this support level of 1.5340, which was our low from last week's consolidation. In that claimant count report for the month of March, we saw that those continuing to claim unemployment benefits dropped by 32.9 thousand for the month, which was a better than expected result. Plus, we had a positive revision to February's data. The claimant unemployment rate dropped to 4.8%, while the ILO unemployment rate for the 3 months through February did rise to 8.0%, putting a negative counterweight to the positive claimant count figures. The better than expected data also coincided with the Bank of England meeting minutes, which were relatively hawkish, as it suggested that Monetary Policy Committee members are concerned about the recent rise in inflation, which we saw come out on Tuesday had reached 3.4% on an annual basis, higher than expected. But also the minutes showed that members think that the downside risks to the economy have eased. In a daily look at the pound-dollar pair, we had seen the pound pressured very strongly between December and March, as we had fears of a double-dip recession, plus the recent election news helped to give this final swing down to 1.48. We now come and test this level here around 1.5550, which was our support back in February, which we cracked in late February, and now we are retesting that level as resistance. So we'll see if further positive data can help the pound give it a further boost and make it push up past this resistance level. We have retail sales data coming out as well as fourth quarter preliminary GDP to end the week, so there should be some event risk following those releases. Now we do have the constant undertone of the UK elections, which are coming up on May 6th, so that will continue to push around the currency markets as we get closer to the election. Turning to the dollar-yen pair, we saw today that we moved pretty much sideways. Following this rally, we saw the last two sessions to come to a high near 93.44. This could mean that the dollar is consolidating its gains, and in New York trading, we did see the dollar coming close to retest its highs as of noon New York time. If we zoom this pair out, we see that we did break this downward sloping level of resistance, and now we come to approach this horizontal level of resistance that we had set here on April 14th. We also used our 200 period moving average as support during today's session. The yen wasn't helped by reassurances from Bank of Japan Deputy Governor Nishimura that the central bank is keeping all policy options open. He made this comment after making a positive assessment of the economy and the outlook for deflation. Bank officials have come under intense pressure from the government in recent weeks to keep monetary policy loose, and in the grand scheme of things, Japan will continue to lag others in terms of interest rate outlook expectations. Turning to the US dollar Canadian dollar pair, we saw it fall to a new low for the week at 0.9928. That was a fresh 22-month low for this pair. Following that test here at 0.9928, we did see risk aversion pick up as European stocks slid, and oil prices also fell, which gave the greenback a chance to pair some of these losses we had seen over the last 2.5 sessions. We moved up to test the parity level, and that did act as pretty strong resistance as we had a rejection following that test. We did also see a bit of a negative wholesale sales report from Canada, which could have pressured the Canadian dollar. Yesterday, of course, we saw a highly anticipated statement from the Bank of Canada in which it lifted its conditional pledge to contain its ultra-low benchmark interest rate at 0.25% until the second half of the year, which opened the door to a possible June rate increase. If we take a look at the Aussie-US dollar pair, we saw that the Aussie slid in today's trading following a test of 93.36 until it came to 0.9261, so about 70 pip fall following this rally we had seen in the last two sessions. Gold prices, which had been pressured for most of the session, did turn up in around noon New York time, so that could give the Aussie some strength in the later part of New York trading. So those are all of our key market highlights and fundamental data from today. So let's take a look at what we can expect in tomorrow's session's fundamental docket. Tonight, Japan posts data on its trade balance, which will be followed by Australia's new motor vehicle sales. Overnight, Switzerland posts its trade balance, and Germany and the Eurozone will release flash versions of their manufacturing and services PMIs, while the UK releases data on retail sales, government borrowing, as well as industrial orders. Tomorrow, in the North American session, we have U.S. jobless claims, producer prices, existing home sales, as well as a government measure of housing prices. From Canada, we get the Canadian Leading Index, as well as the Bank of Canada Monetary Policy Report. So that's a pretty busy day of fundamental data, so we'll see how it affects the markets in tomorrow's video recap. And that will wrap it up for today's broadcast. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you good trading.